Hey, it's Market Moves coming at you, and this video goes out to all my option traders out there. This is going to be a video to explain how you can calculate risk to reward when trading options. I get this question all the time, and the good news is it's not that hard to do, so stay tuned and check it out. If you're frustrated or curious on how to calculate profit zones and stop zones for options, please like this video. I'd greatly appreciate it. It just lets more and more people see this video. Thanks. Just some background on options. Options are a great way to leverage small amounts of money to control a lot of stock. For example, this is a Facebook call option that is expiring tomorrow, and it is currently worth $200 because you multiply that number by 100, and it lets you control 50 shares of Facebook. And this, if it moves higher, can control upwards of 100 shares. And just for reference, you're controlling $8,000 worth of Facebook stock with a $200 option contract. And Facebook right now is up almost 1%, but that option contract is up 18%. So you can kind of understand why people flock to options. But there's so much confusion on how they move and how to calculate the actual risk to return and how much you can expect to make. But I'm going to show you how easy it is in this video. In order to predict how much you can make in a trade, you have to have a trade setup, meaning you have to know which direction the stock could be going in the next week or two. Right here, this is Apple, and I'm just going to use this as an example. I think it's going to go back up to 214 in the next couple weeks. So right now it's trading at about 194. That would be a 20-point move from here. And this is exactly where you want to start. First, you want to find the setup. Then you want to find a target, a profit target. And the next thing you want to do is find a stop loss. Boom, there we go. I think if we break 191, then the uptrend is going to be dead, and I'm going to take a loss right around there, which is a 3-point move lower. So 20-point move higher, 3-point move lower. That's a great risk to reward of 6. But with options, it may be even better. So now that we know our trade, the direction we want it to go, and our profit zone and our stop loss, now we can actually calculate how much we could make or lose if it actually moves in that direction. So when you're going to buy an option, you're going to have to go through the option chain, and there's two big things you have to look for is the right expiration date you want for your option, and you also want to look for the right strike price. After you figure out these two, then you can figure out how much you're going to make or lose if the option moves in your direction or against you. So for my Apple setup, I think it's going to take no more than 7 to 10 days to get up to 214 again. And my strategy is once I know how many days I'm going to be in this trade, I'm going to multiply that from a factor of 3 to possibly 10 on how safe I want my option to be. And that's going to give me my expiration date, which would be around 50. Once you open up the option chain, you're given a bunch of strike prices. This just changes the amount of leverage you can have with your Apple option. So I like to pick something that is, $200 to $500, so relatively cheap. And I would pick the 205s, honestly. So these are trading. You have to average these two costs, $360 and $500. These are trading at about $400. So just to recap, there's some more homework you need to do once you find the trade. You actually have to predict how long the trade's going to take, and that's going to help you decide the expiration date for your option. My rule is to multiply that time expected by 3 to 10, depending on how safe you want your option to be, because it loses value quicker when it gets closer to the expiration date. So the further your option is out, the less you're going to lose per every day you're holding the option, because there's some time decay involved with these. But at the same time, you're also losing a lot of leverage if you go too far out, because it costs more to have that option in the same strike price. So just for reference, the 205 calls I picked out for Apple, I control about 33 shares, and it cost me almost $400. Right now it's looking at about 425. But if you look at the options with less time on it, so 8 days left till expiration, those 205s are now worth about $27, but they only control 8 shares. So every day you're holding the option, you're going to lose money and you're going to lose leverage. So you would have to go to the 195s to get the same control as your other option at 205. So as you can see, there's a lot of ways that options can lose value, and it's very hard to calculate the risk to reward because of this. Even if the option didn't hit your stop price or didn't hit your target zone, you could have that $400 option worth $27 if it just didn't move for the next 50 days. So real simple, I'm going to show you how much you can expect to make from holding these 205 options. So if we move 20 points, which is my expected target in Apple, all you have to do is travel up the option chain 20 points. So 10 points would be 195 and another 10 points would be 185. So if we move 20 points, these options would be worth around $1,000 and about $450. So your initial investment of $425 would be up over 300% holding these options. But there's one trick to doing this. For me to get this 300% return, the option would have to move 20 points either tomorrow or the next day, just because of the time decay and the volatility decay. So if you want to know the true amount you would make, you would have to scale back to the 43-day option. So this would be a 7-day difference. So 7-day difference, 7 days of time decay, and then we head back to the 185s again. And these 185 options are trading at about $1,315. So that's about a $100 difference for holding it for that 7-day period, and that's all due to time decay, volatility decay, and all that. And just for reference, so let's say it takes 30 days for this move to happen. So let's look at the 22 days till expiration options, and the 185s are now trading at about 1,100. So you're going to lose an extra $300 now in profit if the move takes this long. Now let's calculate how much we would lose if it hit our stop zone. So if you know, I was hoping for a 3-point move lower, and that's where I would exit around 191. So 3 points is right around this 207.5 and 210 call. So these calls are trading about 300 to 350. So you want to go right in the middle of these, just because there's no 3-point difference between 205, just because they move in 2.5 increments. So it's going to be closer to 207.5 than 210, and I would have to guess that it would be trading at about 350, maybe even 300 if it dropped 3 points lower. So if we have an option that is $425 and it drops down to 300, that would be a loss of 25%. And this, like I said with the previous target zone, this would have to happen tomorrow because there's going to be time decay that could make this more than 25%. So let's say it takes a couple days, let's say another 7 days to drop back 3 points. In this case, those 207.5 calls would be worth less than $200 just because 3 points under 205 would be around 208. So we have to go a little bit closer to the 210s. So we'd be trading at about 200, maybe even 190, which would be a more than 50% loss from where we bought it. And just to recap again, our target zone after we calculated 7 days of holding the option, if it moved 20 points, we'd make about 300% on that option. But if it took 7 days to hit our stop loss, we would lose about 50% holding that option. And all I did was move up and down the option chain to calculate that. So 300% or 50%, that's a risk to reward of 6 to 1. So that's a very good risk to reward ratio. It's a good trade to take, but if your charting skills were bad and your setup was not good, then it's most likely going to hit your stop loss much quicker than your profit zone. So it all depends on how good you are at charting as a trader to execute these setups and make profit from these options. So I'm going to recap my strategy in 1 minute just so you can see all the steps done relatively quickly. So the first thing I do when I'm option trading is I look for a pattern, I look for a trend, and it looks like this trend is upwards, so I'm looking for this 214 target to get hit. So I found the trend, I know the direction, and I found my target. Next, I have to find my stop loss zone. So I'm thinking there's some support at 191, but if that breaks down, then I'm not interested in holding this due to the trend probably being dead. Once I find the trend, I have to calculate in my head how many days I think it's going to take to hit that target, and I'm guessing it's going to take 7 to 10 just by looking at the past results here. So So 7 to 10 days to move 20 points means I should be multiplying that by 3 to 10 in between that increment. So head to the 50-day expiration options. That should give me plenty of time to be in the option and not lose a ton off time decay, and give me some time to actually hit my targets. So when I went to these options, the only thing I look for as a trader is $200 to $500. That's kind of my sweet zone for holding an option, and that is right around those 205s. These are trading at about $425. So what I do next is I have to calculate the profit zone and the stop zone. So from 205, if I'm expecting a 20-point move, then I just move up the option chain 20 points higher. So this brings me to 195, then 185 would be 20 points, and those options are trading at about 1,450. So from this to here, that's about a 300% move. Now I have to calculate the downward move if it happens. I have to be ready for that stop loss to be hit. So 205 minus 3 points would be around 208, which is very close to 207.5. So I would put that right at the lower end of this bid-ask spread rate. So 315, maybe even 320, which would give me a 25% loss from here if this happened tomorrow. But moves never happen today or tomorrow, they happen over time. So let's head to 7 days later, which is the next option chain, which is going to incorporate that decay, the decay of time and volatility. So 185s are now trading at about 1,325 or 1,330, and that would be about 280% return, a little bit less than the return if it happened tomorrow. But the stop loss gets worse and worse as time decay comes. We're going to be coming at 225 for our stop loss, maybe even 210. So that would be a loss of more than 50% from where we're holding it now. And boom, that's my strategy in 90 seconds. That's what I do every weekend for my premium group. And I just want to link some more videos and options. If you want to become an options trader or be better at it, please watch the videos to the right of me. They're going to help you educate yourself in this market. And if you want to trade options with me personally, 7 days for free, you'll get 3 to 5 option trades a week. That's going to be a link below that. And then please subscribe to this channel. I would greatly appreciate it. Market Moves signing off. Peace.